Well, we've just passed the last day of February, the last working day of February, and it was a Friday, normally a smackdown Friday, and that would have been the perfect day for the shorts to smack the price down. But the price of gold and silver rose this Friday, unusually, so basically the shorts failed to outwit the longs as they often do at the end of the month or on a Friday. Gold has now established itself above $5,000, well above. It's a couple of $100 above that now. And I think this $5,000 and higher is the new norm. And silver looks like it's established itself above $50. So I think this wasn't a fleeting move as we moved above these levels. It looks like it's going to be permanent. I think that these are the new lower levels and they're holding. So for years, the conversation regarding gold or silver was about the rising prices of everything, retail prices, consumer prices. It was about the shrinking purchasing power and how you could stay ahead of inflation. But that discussion has now evolved. The discussion is no longer just about inflation, it's about confidence. Confidence in currencies, confidence in debt, or rather government debt, and confidence in the system itself. We have moved from a world where people were simply trying to keep pace with inflation to a new one where people are starting to prepare for the potential failure of the monetary system itself. So the focus has evolved from managing inflationary pressures to confronting the broader risk of systematic monetary failure. And I think that could come at some point in the next 10 to 20 years, and probably a lot sooner than that. So the conversation is no longer about staying ahead of inflation. It's about positioning yourself and myself for a world that might emerge after the current monetary system reaches its limits. And as I said, I think we're very close to that limit now. We're at 5 minutes to midnight. First, let's look at why precious metals endure these types of events. Gold and silver have always been money. Empires have risen and fallen. Currencies have been printed, debased, devalued, destroyed. Yet precious metals have endured. They've survived kingdoms, wars, revolutions, political upheaval, natural disasters, inflation, hyperinflation, invasions, confiscation, seizure, and taxation. Somehow, those who could hang on to their gold came out the other side as well off, if not in many cases, much better off than they were before the situation arose. Central banks, both large and small, are increasing the gold in their reserves. At the same time, they're very quietly reducing their exposure to the US dollar. With American debt climbing higher and higher relative to GDP, the debt is growing much faster than the growth in the economy, or much faster than the growth in the gross domestic product. The monetary authorities around the world are now preparing for a future in which the dollar may not be the unquestioned reserve currency. We don't have panic yet, at least not now, but they are positioning themselves. And prudent individuals, like you, my viewers, are also doing the same. Now, gold and silver are quite different. Gold has the advantage of portability. It concentrates a great deal of wealth into a very small, discrete form. In times of war or crisis, those who are forced to flee are far more likely to carry a handful of gold coins than they will lug a suitcase full of silver coins. When mobility matters, when you've got to go somewhere in a hurry and hide it, gold offers density, discretion, and convenience. Silver, however, plays a different role. In a world where the monetary system is faltering and everyday transactions return to some sort of tangible exchange, silver is far better suited than gold for that purpose. Its lower unit value makes it practical for day-to-day trade, for swapping for food or fuel or services or commerce. Now we're going to look at the silver deficit quickly, and we'll see that the silver deficit is getting bigger. Let me bring that up for you. So what you're looking at here on the screen is, I've done it every 2 years just to make it simple with the estimate for 2026. We've got the mined supply of silver, which has been falling. Now, the mined supply is falling because the easy silver has been found, and most of the silver which is being mined as a byproduct of another metal: copper, lead, tin, zinc, nickel, those sort of things. So unless the demand for those other metals goes up dramatically, the supply of silver isn't going to rise very much. The industrial demand, on the other hand, has been rising at just the same time as the mine production has been falling. So the silver coming out of mines has been going down. As you can see on this chart, from 2016 to 2026, it's gone from 900 tons down to now about 819 tons. That's just an estimate for the current year, but a significant reduction in mined silver. At the same time, industrial demand for silver rather, what people are using, has gone up from 780 million tons to this year, 2026, an estimated 1,021 tons. So silver consumption has risen, and it's currently standing well above the mine supply. And we also know that virtually 100% of all the silver produced each year is consumed. So there is no doubt that a short squeeze is underway. We've seen in the last few years this deficit of silver, which has been met by the above ground stocks of silver, recycled silver, by people selling back their silver. Silver's come out of the woodwork to meet that demand, but of course that's caused the price to go higher, because to get that silver, the silver which is needed by industry, you have to bid up. So someone says, oh, I like the price, and they go down to the coin shop or they go down to the smelter with their candlesticks and try and get some extra money for them. So in my view, there's a short squeeze underway. Let's look at the inventories around the world. Shanghai silver. That's down to just 306 tons as of the 27th of February this year. To put this in perspective, in January 2021, the figure was over 3,000 tons, 10 times as much. Or another way of looking at it, 90% of the silver held in the Shanghai exchange has now gone. If we look at the LBMA, the amount of silver in the LBMA, although it's been rising in the last few months, it is still only half what it was in 2021. And last but not least, the inventory in COMEX is literally falling off the edge of a cliff. So the gold to silver ratio, which was about 100 to 1 a month or two ago, still about 60 to 1 or 57 to 1, something like that, looks like it's on its way to perhaps 10 to 1. I don't know where it'll end up, but the gold to silver ratio looks like it's going to get better. Now, what does that mean? It means that silver should perform faster than gold and at a better pace than gold. But something else is going on in the world, and that's India. Now, for those of you who don't know, India has passed a new law whereby Indian equity funds will be allowed to invest up to 20% of their assets into gold and silver. Previously, that allocation was restricted to investments like real estate investment trusts and investment trusts generally. So 20% of assets in equity funds could now find their way, as well as general funds, could now find their way into gold and silver. And we know that the Indians love gold and silver. Also, they passed a law saying that lifestyle trusts can invest up to 10% in gold and silver. Now, lifestyle trusts are the kind of trusts where they modify the asset allocation of the fund as you get older. And we all know Indians love gold and silver. So this will open the floodgates when it becomes law on the 1st of April. In another modification, India has announced that the funds no longer have to rely on LBMA pricing. Now, we all know that the LBMA price is fixed. It doesn't reflect the free market price. If you go to buy coins in a coin shop or on the stock market or somewhere else like that, it'll be different. So in future, Indian funds are going to have to take the free market prices from recognized Indian stock exchanges, and the LBMA price, which was fixed, is becoming less important. And who fixed the LBMA price? Well, it's Citibank, Goldman Sachs, HSBC, JP Morgan Chase, and of course Morgan Stanley. So all these banks get together a couple of times a day and discuss what the silver price should be. They put in their bids and asks, and they arrive at a generalized level. The smart money is starting to move out of US equities. We've seen a few examples of that, where some systematic and quant funds have even taken their equity exposure down to zero, one or two perhaps even negative. And they're rotating into defensive assets, some of which include treasury bills and bonds, of course, but some are moving into gold. Now, this is a very, very early sign. These are the smart boys who've got a lot of money. It's not really moving the market yet, but this money's not reacting to the headlines. It's more starting what will be a structural change to have more gold and silver in the portfolios. Now, I'm going to let you know what will happen if a small amount of money moves into gold. So all the above ground gold in the world is worth about $16 trillion. And most of that gold is owned by central banks. Gold ETFs represent just $500 billion. That's 1/32 of the amount owned by central banks. And silver ETFs are worth even less than that. It's a tenth of that. And the gold mining sector, now we're talking about companies, and the silver mining sector, if we take all the gold mining companies and put them together, they're valued at $700 to $800 billion. That number is a fraction of any one of the top 20 companies in the world. For example, Nvidia is worth more than $3 trillion. And the value of the gold mining sector is just a fraction of that.